What if I told you there are hidden gems in the stock market right now, just waiting to be discovered? Stocks that are primed for massive growth, but for some reason, everyone else is sleeping on them. That's right. In this video, we're diving deep into the exciting world of undervalued stocks, and I'm going to reveal my top 10 undervalued stocks to buy now. These stocks have the potential to make you some serious money in the coming years. We're talking about a leader in the food industry with iconic brands, a telecommunications giant paying a juicy dividend, a tech innovator disrupting the IT space, and so much more. We'll uncover the hidden potential of these companies and why they deserve a spot in your portfolio. If you only watch one video today, make sure you watch this one all the way till the end. Hit the like button, let's get 1,000 likes on this one, share the video and leave your thoughts in the comments, and subscribe so you don't miss out on the next important financial investing update. Let's kick things off with a company that needs no introduction, Kraft Heinz. Ticker symbol KHC. You know them, you love them, you probably have at least 5 of their products in your pantry right now. We're talking about iconic brands like Kraft Mac and Cheese, Heinz Ketchup, Philadelphia Cream Cheese, Oscar Mayer, and the list goes on. These are household staples that people rely on, and that kind of brand loyalty is priceless. But here's the thing. Despite their strong brand portfolio and global reach, Kraft Heinz is currently undervalued by the market. Investors have been sleeping on this consumer goods giant, turned off by temporary setbacks and short-sighted analysis. That's where we come in. Kraft Heinz Company has a market cap of $35.02 billion, an EPS of 1.12, and a PE ratio of 25.75. In 2023, they reported a revenue of $26.64 billion and a net income of $2.85 billion. Plus, they offer a dividend yield of 5.53%. Kraft Heinz has been strategically streamlining its operations, focusing on its core brands, and investing in innovation to attract new customers. They're also expanding into emerging markets, where demand for packaged foods is on the rise. Now, I know what you're thinking, packaged food? Isn't that a dying industry? Well, think again, people will always need to eat, and Kraft Heinz is adapting to changing consumer preferences by offering healthier options and catering to different dietary needs, but that's not all. Remember those juicy dividends I mentioned earlier? Kraft Heinz has a history of paying solid dividends, making it an attractive option for income-focused investors. And with its current valuation, you're getting a great entry point to potentially benefit from both stock price appreciation and those sweet dividend payouts. Now, before we dive in deeper into today's list, I want to let you in on a little secret that could completely transform how you invest and grow your wealth. This video is sponsored by Forecaster Terminal, a tool I've been using to uncover these incredible stocks, and honestly, it's been a game changer for my research. This software, powered by the Forecaster AI agent, uses cutting-edge artificial intelligence to analyze all financial instruments, whether it's stocks, ETFs, cryptos, indexes, forex, and even commodities. It's like having your own expert financial analyst working around the clock to give you the most accurate insights and uncover new opportunities. With Forecaster, I can quickly identify value stocks, growth stocks that are ready to break out, and even spot seasonal trends in the market that most investors overlook. I can spot insider transactions in seconds. It also lets me compare companies side by side with their competitors, giving me a full stock analysis instantly. Things that used to take me hours or even days are now done in a matter of seconds thanks to the Forecaster AI agent. One of my favorite features is the Insider Transactions tool. Imagine knowing when CEOs and executives are buying or dumping shares in their own companies. That's a strong signal about what they believe is coming next. The political tool tells you when politicians are buying or selling shares in a company. And with the overbought, oversold indicator, you can tell if a stock is near its peak or bottom, helping you make better timing decisions. And the best part? All these powerful features, once reserved for the elite investors and market gurus, are now at your fingertips thanks to Forecaster. If you're serious about investing, this is the tool that can completely transform your portfolio. It's designed to help you find opportunities, reduce risks, and make smarter decisions that could grow your wealth faster than you thought possible. So, if you're ready to take your investing game to the next level, click the link in the description now to try Forecaster Terminal for free, and use my code Galore10 to get a 10% discount when you sign up. Don't miss out on this game changer for your portfolio. Now let's shift gears from pantry staples to the exciting world of telecommunications with BCE Inc., the leading telecom provider in Canada. You might know them better by their brand name, Bell Canada. BCE is a true behemoth in the Canadian market, with a dominant market share in wireless, internet, and television services. They're the company that keeps Canadians connected, and in today's digital age, that's a pretty powerful position to be in. Think about it. Everyone needs internet, right? Whether it's for work, school, entertainment, or staying connected with loved ones, A reliable internet connection is no longer a luxury, it's a necessity. And BCE is the company providing that essential service to millions of Canadians. Financially, BCE Inc. boasts a market cap of $20.53 billion, an EPS of 0.09, and a P/E ratio of 250.06. In 2023, they reported a revenue of $24.67 billion and a net income of $2.26 billion, with a dividend yield of 12.87%. But here's what really excites me about BCE, its stability. The telecom industry is known for its predictable cash flows and resilient demand, even during economic downturns. People still need to pay their phone and internet bills, even when times are tough. This stability translates into something every investor loves: dividends. BCE is a dividend aristocrat, meaning they have a long history of consistently increasing their dividend payouts year after year. And let's be real, who doesn't love a steady stream of passive income? With BCE, you're not just investing in a company, you're investing in a cash-generating machine that can provide you with a reliable source of income for years to come. If you're looking for a company riding the digital revolution wave, look no further than Endava with ticker symbol 𝗗𝗚. This UK-based company is making serious moves in the IT services industry. They help businesses adapt and thrive in the digital age. Endava specializes in digital transformation solutions. They revamp operations using cutting-edge technology. They're like the tech wizards of the business world. And they're incredibly good at what they do. Endava plc has a market cap of $1.95 billion, an EPS of 12 cents, and a P/E ratio of 283.52. In 2024, they reported a revenue of $740.76 million. Their net income stands at $17.12 million. Endava's global reach excites me. Offices in Europe, North America, and Latin America. Their global presence taps into diverse talent pools. They understand regional needs and tailor services. Building strong client relationships is key. Their customer-centric approach drives success. Investing overseas can seem risky. Endava is listed on the New York Stock Exchange. Strong financial performance ensures peace of mind. Diversify your portfolio with Endava. Innovative solutions and global reach position them as a dominant force. Alright, let's talk about a company that's literally changing the way we pay for things: Global Payments, ticker symbol GPN. This Atlanta-based giant is a pioneer in the payment technology sector, and they've been at the forefront of the digital payment revolution. Remember those clunky credit card machines from the past? Well, Global Payments is making sure those become a distant memory. They're all about providing seamless and secure payment solutions for businesses of all sizes, from your local coffee shop to multinational corporations. Whether it's point-of-sale terminals, online payment gateways, or mobile wallets, Global Payments has got you covered. They're basically the behind-the-scenes heroes of every transaction. And here's the thing, the world is going cashless, and Global Payments is perfectly positioned to capitalize on this massive trend. As more and more people ditch their cash and opt for digital payment methods, Global Payments services become even more essential. They're not just riding the wave, they're driving it. So if you're looking for a stock that's directly tied to the future of commerce, Global Payments is a no-brainer. With a market cap of $27.89 billion, an EPS of $5.32, and a P/E ratio of 20.60, Global Payments is financially robust. In 2023, they reported a revenue of $9.65 billion and a net income of $986.23 million. Plus, they offer a dividend yield of 0.91%. Now, one of the things that really impresses me about Global Payments is their strategic approach to growth. They're not afraid to make bold moves, and they've been on an acquisition spree, snapping up smaller payment technology companies and expanding their reach even further. For example, they acquired 𝗗𝗟𝗏, a leading provider of payment processing services, in a massive deal worth over $20 billion. This acquisition alone significantly expanded Global Payments' global footprint and solidified their position as a true powerhouse in the industry. Talk about making a statement. But it's not just about getting bigger, it's about getting better. By acquiring these companies, Global Payments is able to integrate their technologies, streamline their operations, and offer even more comprehensive solutions to their clients. They're constantly innovating and evolving, which is crucial in the fast-paced world of technology. So, when you invest in Global Payments, you're not just investing in a company, you're investing in a whole ecosystem of payment solutions. They're constantly adapting to the changing landscape of commerce, and their commitment to innovation makes them a solid long-term investment. Let's talk about an American icon reinventing itself for the electric age: Ford Motor Company. Ford is undergoing a massive transformation, and it's electric. They're ditching gas guzzlers and going all in on electric vehicles. The Mustang Mach-E is giving Tesla a run for its money. and the F-150 Lightning is a game-changer. All the power, zero emissions. Ford is diving headfirst into the electric revolution. With a market cap of $35.97 billion, an EPS of 1.47, and a PE ratio of 6.29, Ford is financially robust. In 2024, they reported a revenue of $184.99 billion, a net income of $5.88 billion, and a dividend yield of 8.44%. Now, while Ford's electric vehicle push is definitely exciting, it's important to remember that they're more than just an EV company. They still have a massive presence in the traditional automotive market, with a lineup of popular cars, trucks, and SUVs that continue to sell like hotcakes. They're also making significant investments in autonomous driving technology through their subsidiary, Argo AI. Self-driving cars are the future, and Ford is determined to be a leader in this space. They're already testing self-driving vehicles in several cities across the US, and they're making impressive progress. But here's the thing that really sets Ford apart. They're not just focused on technology for technology's sake. They're focused on using technology to improve people's lives. Whether it's making their vehicles safer, more fuel-efficient, or more connected, Ford is all about innovation that matters. So if you're looking for a company that's not afraid to embrace the future while still maintaining its strong roots, Ford is a solid choice. They're an American icon that's reinventing itself for the 21st century, and I think they're just getting started. Number 6 on our list of undervalued stocks, Adient plc or ADNT. Adient is a global powerhouse in automotive seating. You've probably sat on one of their products. They supply Ford, GM, BMW, and Mercedes-Benz. Adient is innovating for the electric vehicle revolution. With a market cap of $1.43 billion, an EPS of -21 and a PE ratio of -81, Adient is financially intriguing. In 2024, they reported revenue of $14.69 billion and a net income of $101 million. This could be a hidden gem in your portfolio. Adient has faced challenges like supply chain disruptions and chip shortages, but these are short-term issues. The auto industry will recover, benefiting Adient. Demand for new cars is rising, especially electric and luxury models. Adient's fundamentals make it a compelling opportunity. In my book, Adient is poised for a comeback. Let's talk about Albemarle, ticker symbol ALB. Lithium powers everything from Teslas to solar panels, and Albemarle is the king. They extract, process, and sell lithium on a massive scale. Owning some of the highest quality reserves, they have a competitive edge. As EV demand rises, so does the need for lithium. Albemarle is perfectly positioned for the EV revolution. With a market cap of $8.83 billion, EPS of -$16.29, and a PE ratio of -4.26, Albemarle's financials are intriguing. In 2023, they reported revenue of $9.62 billion and a net income of $1.57 billion with a dividend yield of 2.14%. What I love about Albemarle is that they're not a one-trick pony. They're not just relying on the electric vehicle market to drive their growth. They're also a major player in the broader lithium-ion battery market, which is used in everything from smartphones to laptops. This diversification gives them a buffer against any potential volatility in the EV sector. Plus, they're constantly innovating and looking for ways to improve their lithium extraction and processing techniques, making them even more efficient and profitable. Now let's talk about valuation. Albemarle isn't exactly a cheap stock, but remember, you get what you pay for. When you're investing in a company with a dominant market position, strong growth prospects, and a vital role in a booming industry, you can expect to pay a premium. But here's the key. If the EV revolution continues at its current pace, Albemarle's earnings could explode in the coming years, potentially justifying its current valuation and then some. For our 8th pick, we head to China to explore JD.com, listed on NASDAQ as JD. Think of them as the Amazon of China, but with a twist. JD.com has its own logistics network, ensuring faster delivery and lower costs. They can deliver to over 90% of China's population within 24 hours. This efficiency has made JD.com a dominant player in China's e-commerce market. Financially, JD.com boasts a market cap of $58.39 billion, an EPS of 11.58, and a PE ratio of 3.64. In 2023, they reported revenue of $1.08 trillion, a net income of $24.17 billion, and a dividend yield of 1.80%. What I find particularly exciting about JD.com is that they're not just an e-commerce company. They're also heavily invested in cutting-edge technologies like artificial intelligence, big data, and cloud computing. They're using these technologies to further optimize their logistics network, personalize the shopping experience for their customers, and even develop autonomous delivery robots. That's right, robots delivering your packages. This forward-thinking approach tells me that JD.com is not content with just being an e-commerce giant. They're aiming to be a global leader in technology and innovation, which is a bet I'm willing to make. Now let's talk valuation. JD.com _S stock has taken a bit of a hit recently, along with many other Chinese tech companies. However, I see this as a buying opportunity. The underlying fundamentals of the business remain strong, and the long-term growth potential of the Chinese e-commerce market is undeniable. Alright, coming in at number 9 we've got Yum China Holdings with ticker symbol YUMC. Now if you haven't heard of the name Yum China, you've definitely heard of their restaurants. KFC, Pizza Hut, Taco Bell, they're everywhere. And in China, Yum China is the absolute king. Imagine this, you're walking down a busy street in Shanghai, and bam, there's a KFC, and right next to it, a Pizza Hut. That's the kind of market dominance Yum China has in one of the world's fastest growing economies. They've adapted these iconic brands to local tastes, and it's paying off big time. We're talking about a company with over 10,000 restaurants across China. That's more restaurants than some fast food chains have in the entire world. And the best part? They're still expanding aggressively, opening new locations at a breakneck pace. This isn't just about burgers and fries though. Yum China is diving headfirst into technology, using mobile ordering, digital payments, and even delivery robots to create a seamless and convenient experience for their customers. They're not just keeping up with the times, they're defining them. Financially, Yum China Holdings boasts a market cap of $18.26 billion, an EPS of 2.34, and a PE ratio of 20.54. In 2024, they reported a revenue of $11.3 billion and a net income of $911 million. Plus, they offer a dividend yield of 1.33%, making them a solid pick for investors. Now, you might be thinking, isn't the Chinese economy slowing down? And yeah, there are some concerns there, but here's the thing. Even with a slight slowdown, China's middle class is still growing at an incredible rate. More people with disposable income means more people eating out, and when they do, they're heading straight to KFC, Pizza Hut, and Taco Bell. Plus, Yum China is strategically targeting smaller cities and towns, tapping into a whole new market of hungry consumers. They're also innovating their menus, introducing new products and flavors tailored specifically to the Chinese market. They're not afraid to experiment and adapt, which is crucial in the fast-paced world of fast food. So, when you combine their brand recognition, massive scale, and commitment to innovation, Yum China is a company that's well-positioned for continued growth in a market that's only getting bigger. Okay, last but not least, we've got Sirius XM Holdings, the undisputed king of satellite radio. You know that little satellite dish you see on cars everywhere? That's Sirius XM, beaming hundreds of channels of music, news, sports, and entertainment directly to your ears. Now, some people might think satellite radio is a dying breed in the age of streaming, but let me tell you, Sirius XM is proving the doubters wrong. They've got a massive subscriber base of over 34 million, and that number keeps on growing. Why are people still flocking to satellite radio? Well, for starters, Sirius XM offers something you just can't get with traditional radio, or even most streaming services: exclusive content. We're talking about Howard Stern, the biggest name in radio, broadcasting his show exclusively on Sirius XM. And it's not just Howard. They've got deals with major sports leagues like the NFL, NBA, and NHL, giving you access to live games and exclusive coverage you won't find anywhere else. They've even got podcasts, comedy channels, and curated music stations you won't hear anywhere else. But Sirius XM isn't just resting on its laurels. They're constantly innovating and expanding their reach. They've got a streaming app that lets you listen to all their content on your phone, computer, or smart speaker. So you're not just limited to your car anymore. And they're making smart acquisitions like their purchase of Pandora, one of the biggest music streaming services out there. This move gave them a massive library of songs and personalized radio stations, further solidifying their position in the audio entertainment industry. Now I know what you're thinking, all this sounds great, but what about the financials? Well, Sirius XM is a cash-generating machine with a market cap of $8.76 billion, an EPS of negative $4.88, and a PE ratio of negative 5.30. In 2024, the company reported a revenue of $8.7 billion, with a net income of negative $1.67 billion, and a dividend yield of 2.30%. The company has a loyal subscriber base that pays a monthly fee, providing a steady stream of recurring revenue. And with their continued innovation, expansion into new markets and strategic partnerships, Sirius XM is well positioned to keep the music playing for years to come. There you have it, folks. The top 10 undervalued stocks I believe are poised for massive growth. Remember, these are just a starting point for your own research. If you want to start finding stocks like these, Forecaster makes it easy with powerful analysis tools that simplify the process. Try it for free with my link in the description and use code Galore10 to get 10% off if you decide to sign up after your free trial. Like, comment below, and subscribe to Stocks Galore for more insights. Until next time, X.